So, the United States government is currently sitting on what looks like an estimated $43 billion profit.
From a single tech stock.
Right, from a single tech stock.
Right.
But at the exact same time, you have a local cafe owner in the UK who is paying literally double for a tray of eggs just to keep her doors open.
Yeah, it's wild.
It is. And today, we are really dissecting this massive, widening gap between Wall Street's artificial intelligence euphoria and Main Street's physical, everyday economic reality.
Because it's the defining tension of this market right now. I mean, we have an environment where capital is essentially frictionless at the very top, right?
Yeah.
Generating historic wealth on paper.
Yeah.
But then it hits absolute gridlock the moment it touches the ground level logistics of, running a business or housing a community.
And you can see that gridlock being entirely ignored by the broader market this morning. I mean, coming out of the Memorial Day weekend, U.S. stock futures are up. The 10-year Treasury is yielding 4.51%. And the market is pricing in a 98.1% likelihood that the Fed leaves rates exactly where they are in June.
Right, status quo.
Exactly. But here is the thing that really stops me in my tracks today. The U.S. just conducted defensive strikes on Iran, and the market is pushing forward as if it didn't even happen.
Well, the underlying mechanism there is fascinating, actually. It really points to how programmatic trading operates right now.
Because of the algorithms.
Exactly. Algorithmic quant models are currently weighted so heavily toward tech earnings and, immediate interest rate probabilities. So localized geopolitical conflicts they're instantly priced out as non-systemic risks.
Wow.
Yeah, unless a missile directly disrupts a major semiconductor shipping lane or, say, spikes crude oil enough to force the Fed's hand, the financial ecosystem just filters it out as background noise.
It's just ruthless efficiency. Now, before we get into the actual structural shifts driving this market, we need to throw out some of the junk in today's source
Yeah,
text.
please do.
Yeah, we had a couple of press releases cross the desk this morning. One was from Nodthera about clinical data for something called Ruvanaflast, I think, and another from Abeona Therapeutics, just putting out an alert that their management is going to some investor conferences in June.
Yeah, we are completely ignoring those.
Completely. It is pure promotional PR filler.
Yeah.
It's designed to trigger automated news scrapers and bait retail investors, and honestly, your time is way too valuable for that kind of noise.
Sorting the structural from the superficial is half the battle here.
Yeah.
And if we want to look at a genuine structural shift, the most glaring example today is just the sheer scale of capital moving in the semiconductor space.
Yeah.
Specifically regarding the U.S. government's just unprecedented involvement with Intel.
Let's put some numbers to that, because it honestly feels like a hallucination when you read it.
It does.
Last August, the U.S. government acquired a 9.9% stake in Intel, right? Buying in at around, what, $20 a share?
Yeah, $20.47 to be exact.
Right. And looking at the pre-market today, Intel is blowing past $120.
Which is how you arrive at that $43 billion estimated windfall. And we should clarify, this was not a passive index investment.
No, not at all.
This was driven by Commerce Secretary Howard Lutnick actively pushing commercial partnerships between Intel and massive tech customers. It is a highly aggressive, direct effort to fortify U.S. semiconductor manufacturing.
Which naturally has triggered some very loud political commentary. Former President Donald Trump actually spoke about this recently in an interview.
Right, I saw that.
Yeah, and his take was essentially that the government left money on the table. He stated he regrets only requesting a 10% ownership stake when setting up these broader domestic chip efforts, and he joked that he should have asked Intel to give the government the stake for free.
Well, the underlying justification for that stance is what matters economically here. He pointed directly to the $38 trillion national debt.
Yeah, $38 trillion.
As the rationale for this kind of intervention in corporate industrial policy. It's a really distinct framing that blends tariffs with strategic equity investments to try and, force advanced manufacturing back onto U.S. soil.
And we are already seeing the supply chain react to that exact pressure. Apple is reportedly exploring a preliminary agreement to shift some of its chip manufacturing to Intel's foundry business.
Right, but looking at the analyst notes, this isn't for their flagship iPhone silicon.
No. It's mostly for low-end or legacy chips for iPads and Macs.
Because Taiwan Semiconductor Manufacturing Company, TSMC, is still the undisputed king of advanced packaging. Analysts expect TSMC to retain more than 90% of Apple's overall business.
Yeah, TSMC isn't going anywhere, but the fact that Apple is testing Intel's foundry services at all indicates a shift. Supply chain paranoia and geopolitical pressure are clearly forcing major tech firms to diversify their manufacturing footprints.
Even if it is just at the margins to appease Washington.
Exactly. But this leads to a massive philosophical question. When I look at the government sitting on a $43 billion return from an equity position, I really have to wonder, is the U.S. government acting less like a regulator and more like a Silicon Valley venture capitalist wearing a stars and stripes suit?
That's a great visual.
Right. Like, is this a new era of state capitalism disguised as national security?
We are definitely crossing a historic threshold. I mean, traditionally, U.S. market intervention involves rescuing failing entities. Think of the auto industry or...
The bank bailouts in 2008.
Exactly. The goal there was stabilization. This Intel situation is entirely different. This is a strategic, equity-based investment in a foundational technology that is actively generating alpha.
It's wild.
It completely blurs the line between a sovereign state securing its supply lines and a sovereign wealth fund actively trading the market. It changes the incentive structure between Washington and corporate boardrooms entirely.
And you see that complex incentive structure playing out with AMD, too. They're trading up over 3% today, nearing $482 a share. But AMD's momentum right now, I feel like it's just being pulled along in NVIDIA's slipstream.
Oh, absolutely. NVIDIA's forward outlook is creating a gravitational pull for the entire sector. They're signaling insatiable demand for AI infrastructure.
Right.
And simultaneously, AMD is ramping up their own Vera CPUs and Rubin GPUs. These are their next-generation processors specifically designed to handle massive data center workloads and train complex AI models.
So the market assumes that if NVIDIA's pipeline is overflowing, AMD is going to capture a very lucrative piece of that expanding pie.
Precisely.
But wait, the U.S. government is actively managing who gets to buy that pie.
Yeah.
We just saw approval for the sales of the H200 chips to about 10 Chinese firms.
Yes.
I'm trying to square the circle here. On one hand, Washington is heavily restricting advanced semiconductor access to China for national security. But on the other hand, they are greenlighting these specific sales. Where's the logic in that?
The logic is found in the R&D cycle. The U.S. is trying to thread a microscopic needle here. Yes, they want to restrict China's access to the bleeding edge of AI infrastructure.
Sure.
However, China accounted for over 22% of AMD's net sales in fiscal 2025. You cannot starve your own domestic tech champions of a market that represents a fifth of their revenue.
Because that's the exact capital they need to fund the research and development required to stay ahead of global competitors.
Exactly. You cut off that revenue, you cripple their R&D.
So they are essentially allowing enough sales to keep AMD's research engine funded, but not enough to hand over a strategic technological advantage.
It's very tight rope.
It really is. But let's leave the stratosphere of billion-dollar tech foundries and government equity for a second, because there is a physical limit to this AI supercycle, and it's found in the friction of the real-world economy.
Actually, economist Mohamed El-Arian captured this perfectly recently. He noted that we are in a, quote, tug of war between profound technological shifts and stubborn macroeconomic realities.
That is exactly it.
The astronomical wealth being generated in the tech sector is completely obscuring the structural pain happening on the ground level.
So let's look at exactly what that pain looks like. Our source stack today includes a hyper-local report from Gorey.
Ah, the small community on the UK island of Jersey.
Yes, exactly. There is a cafe owner there named Tracy who is getting absolutely crushed by food inflation. Over the last 3 years, a standard tray of eggs went from £3.60 to £7.90.
More than double.
Yeah. A case of bacon jumped by 10 pounds. Her coffee beans, the exact same supplier she's used for decades, spiked by 80 pounds a case literally overnight.
And we really need to look at the mechanics behind those price spikes, because this isn't just general inflation. This is a breakdown in regional logistics.
Right.
DFDS, which is the ferry freight provider for the island, recently shifted to a flat rate freight model.
Okay, I am looking at this DFDS flat rate model. And, on paper, flat rate sounds egalitarian, like everyone pays the same rate. So where is the math breaking down for these small local businesses?
It breaks down the moment you understand how economies of scale subsidize local commerce.
Okay.
Previously, businesses moving large volumes of essential goods received bulk discounts. That bulk pricing lowered the baseline cost of transport, which kept shelf prices stable.
Right.
But by shifting to a flat rate where everyone pays an identical fee per meter of space on the ferry regardless of volume, those vital discounts just vanished. So the mathematical baseline to move every single egg, every strip of bacon, and every coffee bean onto that island skyrocketed.
And a cafe owner like Tracy can't just pass a 100% price increase onto her customers, or they will just stop coming in.
Exactly. She is forced to absorb the difference, and her profit margins just evaporate.
And it's not just the cost of eggs, right? It's the cost of existing.
Yeah.
That same report highlights a 47-year-old resident, Debbie Krupski, who loves her community, but fears she will have to leave because housing has become structurally unaffordable.
This is exactly the macroeconomic reality L. Arian warned about. We have the S&P 500 hovering near record highs, but consumer confidence is fragile because the physical, non-negotiable costs of shelter, food, and transport are systematically suffocating the middle and lower tiers of the economy.
It's brutal. And if you want to see how that housing squeeze forces terrible policy choices, look at what is happening right now in New York City.
The rent freeze situation.
Yeah. Mayor Zohran Mamdani campaigned heavily on a pledge to freeze rents on about 1 million rent-regulated apartments across the city. It's a massive, headline-grabbing promise to fight the affordability crisis.
Right,
But, reading through the latest updates, the city is quietly preparing to exempt distressed landlords of about 300,000 city-financed and regulated units from this freeze. They are going to be allowed to impose rent increases on vacant units by hundreds of dollars a month.
the pivot from a blanket rent freeze to granting 300,000 exemptions highlights a fundamental economic truth.
Right.
You cannot legislate away the mathematical reality of operating expenses.
You just can't.
The New York City Housing Preservation and Development Department is seeing the balance sheets of these property owners. They know they're underwater.
It's like, okay, it's like trying to cap the pressure in a boiling radiator by just holding your hand over the valve.
That's a good way to put it.
The mayor's trying to freeze the rent, which is the leaky umbrella, right?
Mm-hmm.
But the underlying heat, the cost of insurance, property taxes, and utilities, is still rising exponentially. So the pressure just blows out the side of the boiler, hitting new tenants with massive spikes on vacant units.
And the heaviest pressure point in all of this is debt servicing. Because we are in a higher for longer interest rate environment, commercial real estate owners who rely on refinancing their buildings' debt every few years are suddenly facing borrowing costs that are double or triple what they were a decade ago.
Wow.
It pushes the properties straight into negative cash flow.
Which is sparking severe backlash from the capital allocation side of the city. Billionaire investor Ken Griffin came out and heavily criticized Mamdani's broader tax strategies, particularly a proposed 9.5% property tax hike aimed at closing the city's budget gap.
Right.
Griffin is warning that treating commercial real estate and local businesses as an endless tax reservoir makes the city actively hostile to investment.
It creates a feedback loop. If the operating costs become too toxic, capital flees, the tax base shrinks, and the burden on the remaining residents grows even heavier.
So we have the trillion-dollar tech giants soaring and Main Street logistics fracturing. Let's look at how the middle tier of corporate America is trying to survive in this high-pressure environment.
Okay.
We have two biotech companies in our stack today, Nexus and Selection. Nexus had just announced a 1-for-8 reverse stock split, and Selection is doing a 1-for-10 reverse split.
Right.
I want to get past the basic definition here. I know a reverse split consolidates shares to raise the price, but why go through the trouble if it doesn't actually change the company's total market value?
It is entirely about institutional survival mechanics. The NASDAQ has strict minimum bid price requirements, right? Usually, your stock needs to trade above $1.
Okay.
If you fall below that for an extended period, you get delisted. But it is deeper than just exchange rules. Many institutional investors, like mutual funds or pension funds, have strict internal mandates that forbid them from holding stocks priced under $5.
Oh, interesting. So it's like taking a pizza that was cut into 10 tiny slices, mushing it together, and cutting it into 2 giant slices so you can charge more per slice. You haven't added a single ounce of new food, but suddenly it looks like a premium product.
A very precise way to look at it. They are artificially inflating the price per share to prevent those massive institutional funds from triggering automated sell orders, which would just completely collapse the stock.
Wow.
It is a defensive maneuver by companies starved of genuine capital, trying to maintain the illusion of stability so they can keep the door open for future financing.
But not every company in the middle tier is playing defense and consolidating their units like that. Let's look at ASUS.
The hardware manufacturer.
Yeah. They just appointed Vernon Coutinho as country manager for Canada, and they are preparing to host a massive ASUS Business Summit 2026 in Toronto.
Right, they're making moves.
They managed to grow their consumer market share in Canada from 5% to 20%, but now they are aggressively pivoting toward the B2B commercial market.
Well, the consumer hardware market is a brutal, low-margin grind. You are fighting over pennies in retail environments. Moving into enterprise and commercial fleet sales is how hardware manufacturers stabilize their revenue streams.
But the hook that you're using for this pivot is what caught my eye. They are banking their entire commercial strategy on organizations refreshing their computer fleets with, quote, AI-ready business
Oh,
laptops.
yes.
They're pushing these ExpertBook and ProArt series devices. But my immediate skepticism here is AI-ready just the magic corporate buzzword of 2026? Like, is this just marketing glitter to convince tight-fisted CFOs to finally approve a hardware upgrade? Or is there an actual physical requirement for these new machines?
The marketing departments are certainly milking the phrase, there's no doubt about that. But there is genuine silicon driving this shift. An AI-ready PC is defined by the inclusion of a neural processing unit, or NPU, alongside the standard CPU.
Okay, but why does a corporate accountant or logistics manager need a dedicated AI chip on their laptop? Can't they just use cloud-based AI tools?
They can, but relying on the cloud introduces latency and, more importantly for enterprises, massive data security risk.
Oh, of course. The data leaves the building.
Exactly. An NTU allows the machine to handle complex artificial intelligence workflows locally, right on the device itself. You aren't uploading sensitive corporate data to an external server to be processed.
That makes a lot of sense.
Furthermore, the entire upcoming ecosystem of enterprise software, from advanced data modeling to automated security protocols, is being built to utilize that local NPU architecture. If organizations do not upgrade their physical fleets, they simply won't be able to run the next decade of enterprise tools.
So ASUS is just reading the tea leaves here. They know every major corporation is about to be forced into a massive hardware upgrade cycle, and they want to be the ones supplying the hardware.
They are attempting to intercept a structural wave of capital expenditure before it fully breaks.
Wow. You know, when you lay all of these pieces out on the table, the U.S. government minting billions on semiconductor stakes, the maritime logistics crushing a cafe in Jersey, New York landlords drowning in debt servicing, and hardware companies racing to supply the AI gold rush, a very stark overarching pattern emerges.
It really does.
It's what you might call a capital allocation disconnect.
Yeah, the systems are entirely decoupled right now.
Right.
You have billions of dollars flowing with zero friction into artificial intelligence infrastructure and government-backed foundries, generating immense paper wealth.
Right.
Yet that capital is completely walled off from the physical economy. Small businesses are starved for margin due to logistics. Property owners are squeezed by soaring baseline costs. Smaller public companies are resorting to financial engineering just to stay listed on an exchange.
The top floor of the global economy is throwing a historic, capital-rich party, and the ground floor is taking on water. And, helping you spot these massive structural disconnects, stripping away the Wall Street jargon so you can actually see the matrix of how this all fits together, is exactly why you can always find this show, along with independent daily world briefs, brain candy rabbit holes, and classic audiobooks over at clarenderatio.com.
It is financial candy designed to give you the context that the headlines miss.
Exactly. Because treating the stock market as an accurate reflection of the everyday economy is a fundamental analytical error.
You have to trace where the money is actually allowed to flow.
Which brings me to a final lingering thought for you to take away today. Let's go back to that $43 billion profit the U.S. government is sitting on with Intel. They essentially acted as an activist investor and won big. If this becomes a normalized, proven strategy, what happens next?
That is the ultimate policy question of the next decade, honestly.
Will future administrations start actively day trading national industries? Will Washington start taking equity positions in green energy, synthetic biology, or aerospace explicitly to generate the returns needed to pay down that $38 trillion national debt?
Wow.
And if they do, does the stock market eventually stop being a reflection of private enterprise and just become another branch of the federal government?
It would require a complete redefinition of what a free market is supposed to be.
Something to mull over as you watch the capital flow today. Thank you for giving us your time and your curiosity. Keep questioning the mechanics behind the numbers, and we will be right back here next time to decode what happens next.